Good morning and welcome to Tea Time with Tucker. It's Tuesday morning. My name is John Green with Association Member Benefits Advisors. Just a couple of housekeeping details before we get started here. All participants are in a listen only mode. And what that means is if you have questions or have comments, you can drop them into chat, put them in the Q&A feature. Periodically along the way, we'll stop and take a look at those and answer those questions. And then maybe at the end, what we'll do, we have time, we will stop the recording. You can hold up your hand on the reaction bar and we can unmute you and you can answer your question live if you want to. I'd encourage you today to grab a pen, piece of paper, take a few notes. We're going to talk about a wide variety of topics about financial wellness, ways to get your financial house in order, some things that maybe you want to request some information from us from, things like that as well. You'll also notice this QR code here on the bottom right-hand corner of your screen. The QR code operates just like the restaurant menus that sometimes we see in the restaurants today. You'll take your smartphone, open up your camera feature, hover over that QR code, and a little form will pop up and you can ask more questions, seek product knowledge, things like that, of things that are out there for you as well. So just jumping in real quickly as we get rolling here, talking about financial wellness today. Sabra called me on the way to about 30 minutes before this conversation today and said, "Hey, I'm running to speak to the Speaker of the House over at the Capitol building on a particular piece of legislation. So some things must have popped up that were hot and pressing. So I'm going to run this operation solo today." But she just wanted to share with you how appreciative she was, not only of the attendance, but the OREA staff at the convention earlier in the month. Had a great time up there. Myself, Amber representatives as well, truly enjoyed that. But it was great to be back together to reconnect and see all the members across the state, as well as get to know a little bit more about what's coming in the coming year. So hope you were able to join us at that. I was able to meet several of you as well, which I really appreciate the opportunity to get back to Oklahoma any chance that I get. So thank you again for that. And I hope you enjoyed the convention and you're back out in your units meeting together as well. Again, my name is John Green with Association Member Benefits Advisors. I live a little bit north of Houston with my wife of 30 plus years. She's a second grade teacher, teaches at the same elementary school that she went to, and my three kids went to. And I've spent the better part of my career working with active educators, helping them understand what their retirement is going to look like after they leave the schoolhouse. But I did get my education start in Oklahoma, in Bethany at Lake Park Elementary School. And so I appreciate the opportunity, like I said, to get back to Oklahoma as often as possible to see where I grew up my early years as well. So jumping on in here, as I mentioned, Sabra is over at the Capitol talking with the Speaker of the House, and that's one of the functions that OREA does on your behalf. They are out there to be a pension watchdog and to look out for those legislative bills that can positively or negatively impact your pension, future educators coming up, things like that as well. The conversations around the stipends for your health benefits and things like that. That's what OREA does on your behalf, and that's what you do on your own behalf as well. So that's how OREA works on your behalf for that. And then just as we saw back in early April and what you're seeing now in your meetings all across the state, keeping you connected to your local community, whether it's with retirees going back and giving back to school, like some of the units are doing as well. That's a very important aspect of OREA's mission. And then because you are members of OREA, you have access to exclusive benefits and discounts, things that you can't get anywhere else, or greatly reduced rates, easier to qualify for, things like that. So that's how OREA in 4 parts works on your behalf as well. And whenever I was talking with many of the members up at the convention in Edmond back earlier in the month, they were telling us, there's some ways that we appreciate having AMBA and OREA together. It kind of helps fill those gaps that aren't covered by what you have from your district benefits and state benefits. They're portable. Many members that we see move out of state, come to Texas, vice versa. You can take these benefits anywhere you go. But really the biggest thing that I got a really enjoyable conversations out of were people telling me about how they were able to extend their benefits to their adult children that may have aged out of their benefits, or to their parents because they were responsible for taking care of their parents as well. So the proper planning, the proper use of your benefits through OREA can kind of help you take care of your family up and down the spectrum. and maybe prevent you from having to take additional time off if you're still working on a second career or something like that. So we're going to jump in today and talk a little bit about a lot of different subjects. So we're going to move kind of rather rapidly. I'm going to talk about some of the changes in Medicare that took place first of this year and how you can be a smart healthcare consumer, especially in Oklahoma with many of you on Health Choice, and ways that you can get the most out of your coverage. So I'm going to cover some things that the Health Choice makes available for you as well. But even after that, I'm going to just discuss real briefly the 4 major gaps that retirees have when it comes to their medical coverage. Share with you some financial tips that have popped up this year, some things, some tools that you can use to kind of get your financial house in order. And then Janet Barr, one of our members, asked me to put together something on RMDs, or required minimum distributions, because as many of you get closer to that age, planning for those things, because you've done some good retirement planning and saving for retirement all along, the RMD question really pops up. So we're going to go in a little bit more in depth about that, introduce those to you, give you a high level conversation, and talk about what some things you need to look out for. As in my career, I have seen some situations where RMDs can really be a help to someone, but they can also be a trip up if they're not handled properly by the individual or by the company that's providing that care for you. So let's go ahead and we'll jump right on in here. Talk about Medicare real quickly. Those of you remember, if you're on Social Security and Medicare, you know that at the beginning of the year, you got an increase from Social Security, which is all right, that's great. It's not really keeping up with inflation, but it was the highest it's been in many, many years. Well, right behind that came Medicare increases in the cost of Medicare. So there's never an increase in Social Security without an increase that comes in Medicare. But Medicare has just wrapping up, and not to say they won't do it again, they're just wrapping up a 10-year plan where they were cutting billions and billions of dollars out of Medicare costs. Everything from payment rates to reimbursement rates, cutting certain services or reducing reimbursement rates for those services. And so they've seen the culmination, and this started back long before certain administrations, doesn't matter what administration, they've been trying to cut Medicare over the past several years out of this. And this is on top of the increases in premiums and co-insurance clauses and things like that for parts A and B. So just a little bit of snapshot of how this works this year. For a cancer patient, let's think about a cancer patient. So give you an example. Grace is a member who receives or who had cancer 8 years ago, and she receives immune therapy, IV therapy periodically to help keep her immune system up so that she resists any future cancer out there. Well, Medicare can come in and they won't cut the service, they won't cut the procedure. What they'll do is they'll reduce the reimbursement rates for certain medications by X%, really small cuts, but in the whole, it adds up to big millions and millions of dollars of savings. Well, the doctor that provides that, or the physician's clinic that provides that for Grace, that may not be close to a major metropolitan area, decides they can no longer accept Medicare patients because that reimbursement cut made it unprofitable, or they couldn't afford to lose money on that particular service or that type of medication. So Grace has to decide, do I pay more and still stay with someone that's close by, that I know, that I'm comfortable with, I'm going to for the past several years, or do I have to change and go somewhere else? So that's how those little bitty cuts in Medicare out there can really eat up an individual, potentially from a financial perspective, but also from an emotional and a change perspective as well. Another way that Medicare has done some things is they've gone in and they've taken procedures that historically were classified as inpatient procedures. They've moved them to outpatient procedures or observation status. The actual procedure didn't change. You may stay still 3 nights in a hospital, but what changes is what Medicare will reimburse for rehabilitation services and care while you're getting healthy again. That changes what Medicare will reimburse for. So again, just some ways to cuts out of Medicare, just to make sure that you're aware of some of those things. So if you do have to have certain procedures, you do have to have certain type of treatments, make sure you ask your doctor first. Well, how's Medicare changed over the past year to make sure that you've got coverage that you want out there? And if you had a life-changing event last year, or you've got a life-changing event this year, you may want to pay special attention, because your Medicare payments, or the cost that you pay for your Medicare premiums, is often indexed to your income. Okay, so remember that, write that down. that your Medicare payments are indexed based on your income, because not only is it your pension income, your spouse's income combined, it could be rent, all these other sources of income. And now as you reach certain ages, your required minimum distributions may kick your income up to a certain category that causes you to pay more for your Medicare. But if you had a life-changing event last year, or you have it this year for next year, such as getting married or divorced, a spouse that passes away, or maybe you were working a second career after you left the schoolhouse and you decided not to work anymore at that. So you've had a greatly reduced amount of income. Then at that point, or maybe you had a spouse that passed away and you lost their pension income, you can file an SSA 44, which is a Medicare-related monthly adjusted amount to your income, which basically says your income is dropped, therefore you may not have to pay as much for your Medicare as you did in the past. So just important to know if you do have a major change or to your income or a major life-changing event, there are some ways that you can avoid having to pay the higher cost for Medicare out there. Okay, so as we jump in here, we're going to talk about several different ways to help you save money, look for ways to make your dollar stretch a little further to maximize what's out there for you. So I want to talk about your medical plans. Know your plans. Know what your copays are, your deductibles, your co-insurance clauses. And everybody's familiar with copays and deductibles. Copay is what that, the dollar amount you pay to the doctor just to go see them, just to even walk through the door, $25, $50, whatever that is. Deductibles then is an amount on top of that you have to pay first before your insurance kicks in. Then co-insurance clauses for certain procedures that would say you're responsible for the first 20 to 40% of this procedure, up to a maximum out-of-pocket amount. And that's the most that you have to pay. Well, some of these plans, depending upon how you get care or who you get care through, they can still be several thousands of dollars for you as an individual and up to $10,000 as a household. So it's important to understand what those plans are. And so as a healthcare consumer, I'm going to challenge you this year to have 5 things, write these 5 things down, a way to be better healthcare consumers. First of all, understand your insurance coverage. Take some time to understand the plan that you have, whether it's health choice through the state, something else, and other different levels of health choice plans. You've got something through a spouse, or if you're just relying solely upon Medicare and some type of supplement or advantage plan. When you go to your doctor, ask about pricing transparency. And here's the reason why I say this is because my wife last fall, I guess it was, she knew it was seasonal allergies. We have fall allergies down in Houston. She knew it was a sinus infection. Well, this is the time COVID was going on, and the doctor wouldn't come see her unless she took a test, and then she could only do some type of a teledoc, visit over Zoom, that type of thing. So she did all that kind of stuff, and the doctor said, you know what, you need to go do some more testing and all this kind of stuff before you even come and see me. She found out that telemed visit was $200 to tell her nothing, to tell her that she wouldn't even do anything for her. So ask for pricing transparency up front. If I do this procedure or if I have this service, what is my cost? What's all going to be in there? Shop around for services. Many more doctors, many more clinics, especially those that provide Medicare services or through Select or Health Choice, they will provide you with transparency on pricing and let you know what your costs are. Take advantage of the perks and incentives that those plans offer you. You've heard the term silver sneakers. You've heard different cessation programs for smoking, different things like that, weight loss, stuff of that nature. There are a lot of different perks that are out there that you can take advantage of to help keep you healthy. And then especially most of all, don't skip those preventative care things. Don't skip those annual physicals, your mammograms, things of that nature. So that's the better way to be a healthcare consumer so that you don't get caught with surprise expenses that are out there. Now, we've got many Oklahoma retired educators that have Health Choice as their plan that they use. And Health Choice has made some changes this year. Most of these are for the better to help you take advantage of what you have available to you and to keep those costs down as well. I would encourage you to look at their benefit app, download their Health Choice app. It's a single source for your claims, your evidence of explanation of benefits, all those things to where that you've got the ability to check and be a better consumer of your health care. Of course, you've got access to it 24/7. access to Swift MD. I'm going to talk about that in a moment. That's a big money saver in Oklahoma. Pretty neat out there. It's got all your medical cards, all your pharmacy cards, that kind of stuff like that. And it allows you to do chat 24/7. So it's a great way to get the healthcare process started, to ask about certain things. If I need this, can I go a certain place? And they can guide you as well out there. So this Swift MD is a great program, especially for those of you in the rural parts of the state, that give you telehealth benefits where you can talk to a doctor 24/7, the provider of your choice. You still have some copays and deductibles and things like that that are in there, but you can use these, like I said, any time of the day. When you're traveling, if you're out of state and still want to stay connected back to a doctor in your area, if you're a high or a basic member, there's no charge for this service. For the HDHP program, it's $45. You need to register in advance, but again, it's a great way to quickly take care of medical needs without having to maybe go into a doctor, do something like that. So Health Choice is really encouraging this as a first line of treatment or consultation with a doctor, and you can do it upon your schedule anytime you want to. And then I mentioned talking about perks and incentives, their wellness program. There's a New Step program for your phone, where it's iPad or iPhones, Androids, that kind of stuff like that. Smartwatches, gives you goals, helps you track those goals, things like that, and provide incentives as well. And then with the Health Choice Select program, or with all the plans as well, you've got this access to certain procedures with unlimited services, certain services. If you'll go to these particular doctors, your costs are less expensive. There's no out-of-pocket cost up front for certain services, things like that. So again, helping you become a better healthcare consumer. So check out Health Choice, because it's a great way to manage your income that way. Leave this phone number up here just real quickly, just a way to go out to healthchoiceok.com, and you can use that number. We are recording this. We'll have this on the OREA website here by the end of the week. Go out there, take a look at your handbooks, look at your provider pages, that kind of stuff like that. You've got your phone numbers. They've got the TTY service for those that are hard of hearing as well. So again, I encourage you to use your resources to be a better consumer of your healthcare and save your money, make your dollar stretch a little bit further as well. Okay. So when we look at the plans, and when OREA and AMBA sit down every year when Medicare comes out and says, here's all the changes that they have, Health Selects, here's all their changes, we go out and look at it and say, if you've got private medical insurance and you're under age 65, there are certain gaps out there. If you're on Medicare and a Medicare supplement or even an Advantage plan, there are certain gaps out there as well. And the four main gaps that we find are home health and facility care, meaning that neither Medicare nor medical insurance pays for any type of home health care beyond a certain small recovery period. There is a significant amount of gap, or size of a gap, for lack of a better term, for cancer, heart, and stroke diagnoses, meaning that a lot of the expenses that that are incurred by individuals who have a cancer diagnosis, have a heart attack, or a stroke are not covered by these plans. And a lot of these are related to travel, related to comfort items, things of that situation, medical transportation. Most ambulance services, especially in the state of Oklahoma, are not part of any network, and therefore you don't have pricing controls on those. So you could be left with a pretty sizable bill out there. And then your medical insurance and Medicare don't cover your final expenses if something does happen to you and you pass away. So those are the gaps out there, and those are things you need to consider as you're looking at your plans and preparing your budget for the coming year as well. So I want to walk through now some ways that you can be financially healthy in 2022. We're going to hit on spending, planning and organizing. We're going to talk about insurance just a little bit, and then protecting that nest egg that you've grown up. And then we'll jump into the RMD. So we're going to bounce around a little bit, try to keep it in a path that you can stay focused on, and give you just a few tips. If you can walk away with one or two things out of here that you can use to help put your financial house in order, then it's been worth your time with us today. The three big budget items that we all have are housing, transportation, and food. It doesn't matter if we've paid off our house, we've paid off our cars, whatever it is, as you know, costs continue to go up, whether it's property taxes, the operation of your home, utilities, things like that, of your car. Those are the three big budget items. So when I did a little research around here, here's some things that I found that can help you possibly keep these expenses under control, or some trends that you're going to see going forward? You're going to see a lot of emphasis on these terms downsizing. And you may have heard this, as you retire, your kids are out of the house, maybe you don't need as big of a house, something like that. You're going to see a lot of trends around downsizing. With housing prices being so high as they are right now, it may be a good opportunity to tap the equity in your home, sell your home, move to a smaller house that's less expensive to maintain, cheaper insurance costs, lower utilities, things like that. You're going to see this term called house hacking. House hacking to me is not something that I'm really interested in myself personally, but it is a term that I've seen out there. It's where people are using their homes to make money. And you see this with people maybe that will put their homes in the Airbnb programs, rental programs. You'll see people that will use their homes, their extra bedrooms, garage apartments to rent them out to someone. That way, they have a steady stream of income coming in. The latest thing that I have seen from a house hacking standpoint is a storage opportunity, where if I've got room, say I've got a storage shed in my backyard, or I've got a big garage where I can store something, there are services you can sign up for that you can list your home as a place for other people to store their stuff. And so it just seems kind of odd to me, but the more I think about it, okay, I've got this extra space, why not use it, pick up some extra cash? So that's some of the things you're going to see in this house hacking trend that's out there. Is people finding ways to make their things that they own generate income for them out there. Home, as far as autos, the trend out there, especially if an RV or a boat, sometimes is people are using those and putting them in a rental pool as well, deriving income that way. Used vehicles that you own right now are at their highest cost point, sales point value that they've ever been. I was listening to a radio program here about a week ago talking about how used cars are going for about $6,000 more than what their Blue Book value is, because dealerships can't get enough new cars, so they're still trying to stay afloat. They're trying to get as many used cars as possible. So if you've got a used vehicle that's not being used, I guess I should say, in your household, now may be the best time ever to sell that vehicle. If you've got less need, meaning that you're not driving as many miles, I would encourage you to contact your insurance company and possibly look at them re-rating your vehicle for insurance and possibly lowering that expense out there. Meals, you go to the grocery store, what used to cost $1 is now $1.50, that type of thing. You're seeing price increases on all different type of things out there. So people looking to save money, use the Passport program, which is your free program through OREA, where you can get discounts at local restaurants. You can also get discounts for meal prep, which means that you've got less waste. The meal comes for you prepared already, and it may be a more efficient way for you to provide meals for yourself or your family. So there's just a few ways that you can save money that way as well. When it comes to insurance, and think about this from a standpoint, we spend a lot of money on home and auto insurance and life insurance. When it comes to your auto insurance, I encourage you to take a look at every year your deductibles. You may have a $250 deductible on your car or a $50 deductible on your windshield. If you raise that to a $500 or $1,000 deductible, you can save money that way. Look at your liability coverage. If you're not working anymore, you may not have as big of a liability you're trying to protect. Make sure you check those things out. Again, I talked about mileage usage. There are many companies that will rate you based on the miles that you drive. Now, I know Oklahoma's got a lot of miles out there between certain cities, things like that. So you may want to be careful if you drive, but if you're not driving much at all, I highly recommend calling your agent and say, hey, I drive less than 5,000 miles a year. Is there a different rate you can get for me? Because they may not have changed that over the years. Look for affinity discounts. There are companies out there that offer discounts for being a retired educator or an educator, that you can extend those out there as well. Look for specialty coverage. You may have had coverage through a company that covered maybe your pets, or may have covered you while you were at school, things like that, a little bit differently. And maybe you don't have a pet anymore. Maybe you don't do certain things that you used to. You can drop those specialty coverages. You may not need those anymore. I highly encourage you to shop around. Take a look at what's out there. Don't always jump, but just know that some companies offer sizable new customer discounts. If you've been with your prior carrier for several years and you're claim free, you could get a pretty good rate that way. But also know that some companies offer loyalty discounts. If you've been around a certain number of years, you may have earned discounts, or you may have earned a reduction in your deductible, something like that, or accident forgiveness. But I encourage you to shop around, have an agent take a look at it and see what's out there for you. Now, when it comes to homeowners insurance, and I know if you're like me, your homeowners insurance goes up every year. And that's because home values, home replacement cost values go up. And I live in Houston, just like you live in Oklahoma. Tornadoes, hurricanes down here where I live, those things happen. Look at your home to make sure that your deductibles are in check. Because again, you may have $1,000 deductible or a 1% deductible on your home. And when a hailstorm rolls through, you're responsible for that amount of money first before the insurance company will pay for that. However, you want to watch, because some insurance companies, and this is not, I don't want to get real deep into this, but some insurance companies will change the coverage on your home as your roof gets older, meaning that you would have replacement cost coverage on your roof if it's less than 10 years of age. But as your roof gets over 10 years of age and it hasn't been replaced, they may change the coverage to where you'll only get what's called actual cash value, which could be a whole lot less than you expect. So look at your coverage. If you have had your roof replaced, let your insurance agent know about that. Look at your replacement value of your home. Replacement value is different than the sales price or the tax record price that you're being taxed on your home. Replacement value is what the insurance company would have value on your home, what it would cost to replace it if it burned all the way to the ground or was totally destroyed in a tornado. Some insurance companies will automatically put 3%, 5% every year on there. And after a while, it will get really out of whack, and meaning that you're paying for more than you need to. So I encourage you, shop around, look for those bundle discounts, because you could save money that way. From a life insurance perspective, and I'm a huge believer in life insurance, but depending upon your age, depending upon your need, if you don't have anybody who's you're responsible for, and you've got enough set aside for final expenses, do you still need that life insurance? You may be paying on something that you don't need out there. Understand the difference between term and permanent insurance. You may have had some term insurance that's coming up at the end of its term, but you still need the coverage. At your age, as we get older, it gets more expensive for permanent coverage. We're not eligible for term insurance coverage, things like that. It's important to understand those things that are out there. Look at your policies. Some of the policies may have some nursing home riders on them, meaning that you can get long-term care coverage from your life insurance policy. So you may not want to drop that policy. Even if you don't need the life insurance, you may want it in case you need long-term care coverage. So take a look at that type of thing. Take a look at it if your premiums are increasing. But if you still want to leave a legacy, you have the ability to leave a legacy to grandchildren, something like that. Many plans have options, meaning that you may not want to pay any more for your premium, but they'll reduce your coverage and you'll just have a flat amount of coverage there for reduced premium and for no premium at all. So like I said, there are some benefits that you have in your policy. I'd encourage you to review those. These savings on here can save you quite a bit of money, but they can also prevent you from having worry in the future. All right, let's talk about planning and organizing. If you're living at home, you've got your home, all that stuff, I'd encourage you to have an ICOD folder, an in case of death or disaster folder. We created one in my household many years ago with hurricanes. We could just grab our folder and go. It's got all of our financial records in there, all of our account numbers, things like that. I'm building one with my mother right now. But I want to show you, and I want you to write this down. And if you want a copy of this, meaning that if you want a checklist that you can use to build your own ICOD or in case of death folder, just email me at the end of the conversation. I'll make sure you get one. In an ICOD folder, it's designed to help you and or your family members deal with your financial situations after you pass away, or if you're no longer mentally fit to do so. So you want to put in this ICOD folder things related to your birth certificates, marriage certificates, divorce decrees, any type of adoption papers, things like that you've got in there, just some of your life events. Then you want to put in there all of your life insurance and retirement paperwork. Now, I'm not saying that you have to put in all of your policies. I would encourage you to take maybe the front cover of your life insurance policy and just put that in there, because it's got the contact information of your agent, or how to get a hold of the company, what the face amount is, and who the beneficiaries are. If you are still working, or if your spouse is still working, please put in any type of contact information for HR, or any of what I call death in service documents, meaning that if you were to pass away while still employed, what benefits do your survivors get? Because if you have a pension, or if you have some sort of a company life insurance plan, some of those coverages change upon death. So put those in there. Put the pension contact information in there. Make sure you have the details of your state pension entitlements. Some of you, depending upon how you selected your pension may stay the same to your surviving beneficiary. Some of you, your surviving beneficiary may get nothing, but they're expecting to get something, or it may get reduced depending upon how you selected your pension benefits. Put that information in there so they know what to expect. And if you've got any annuity paperwork, meaning anything that's coming to you in a periodic payment, please put that in there. Contact information as well. Put your banking account information, account numbers, passwords, login information, because we do so much of it online anymore these days. Put your credit card contact information in there as well. And if you have safety deposit boxes, put where those are, who the contact is, where to find the key, that kind of stuff. My father-in-law's father, so my wife's grandfather, passed away 4 or 5 years ago, and left my father-in-law with a box of about 10 safety deposit box keys. That's all he left. Didn't tell him what bank they were for or anything. So he did a lot of sleuth work to find out where these safety deposit boxes were. So again, you'll help make your beneficiaries' lives much easier if you'll put that information down for them there. Then you want to put about your assets, what you have assets in there. Any type of property, especially in Oklahoma, any land, any cemetery deeds, any timeshare documents, car titles. You want to put your IRAs, your 403Bs, your 401Ks, including your passwords, any of those things you want to put on that list as well. Any type of loans that you've made, any ownership stuff, put that in there. The same for your liabilities. If you still have a mortgage on your home or a reverse mortgage, put that information in there. Any type of debt, such as loans, home equity loans, timeshares, reverse mortgages, that type of stuff, put that in there as well. Just do a high-level list of your monthly expenses. This will give whoever is responsible for your estate, whether you're living or have passed away, who to contact in case you need to cancel some of these things. Loans, rent, mortgage, insurance, utilities, things like that, subscriptions. All the time at AMBA, we get calls from surviving members that say, my mother passed away 2 years ago, and she's been getting billed for dental insurance for the past 2 years, her estate. Unless we know, we can't know to stop those things. So again, that's important to help your surviving members know when to cut these payments off and when to get those things taken care of. With the social media and email accounts out there, make sure you leave your passwords, those type of things, for your cell phone account, any streaming services like Netflix, Disney Plus, those type of things. So again, they can be stopped and cut off out there. Your contact details, your doctor, AMBA representative, lawyer, minister, financial advisor, if you've got one, insurance people, those type of things, put those contacts down there. And then your essentials, such as any wills, trust documents, power of attorney, especially a medical power of attorney. This is huge. If you don't have one, I would highly encourage you to get one. That just basically, it's a simple document. I did it with my mom. We did it for my wife and I, that in case of our medical incapacity, that someone has the authority to make medical decisions on my behalf. And then put any type of instruction letters. I want this to be done for me. These are my final wishes, things like that. Any burial, cremation wishes, things of that nature. You'll simply make your financial house get in order much easier, and make it easier for someone who's responsible for those things after you leave this earth here today. And this is why I did this. This is a photo of my mom and my daughter. There's my mom and my daughter, yes, back at Christmas. And we noticed that my mom was a little bit more repetitive in what she says, forgetting things more often, having to write more things down, things like that. So I'm building this with my mom as we're going through this webinar as well. We're going through here, and so waiting to talk to a family member, whether you're the parent or you've got parents, is a mistake. You need to do that now. And some of these questions you need to ask are, where are these documents? Again, put that icon folder together. Can I meet with your advisors? Mom's been really good. She's pretty healthy otherwise, and knowing where her doctors are, what pharmacy she wants to go to, those type of things, getting to meet those people, getting to know those names, what meds, those type of things. What type of planning have we done for your long-term care? Does she have a plan in place? Do you have a plan in place? Mom, do you want to stay in your home as long as possible? Do you want to move in with us, move closer, go to a retirement community? What are her wishes? You need to ask those questions now, or tell your kids those questions now. What are those final expenses? Come to find out, Mom had purchased a plot outside of Wichita Falls, where our family plot is. She's got a plot there, even though we live 300 something miles away, but she's prepaid for all those things. Just getting to know what her final wishes are. And then again, that question that's uncomfortable, but it's better to do it now than when you're having to make it the question in the crisis, is when there's a medical situation, what kind of treatment do you want? Do you want a do not resuscitate, that type of thing situation? So ask those questions now, you'll appreciate it in the future. I want to show you this document. I want you to write this down. Go out to AARP, or you can just go out and write down Thinking Ahead Roadmap. This was a whole program. And if you want this, I'll give you my email address at the end of the day, and I'll send you this link out here. This is a great program that AARP and the University of Minnesota put together to have that conversation with your family, whether it's your parents or you with your children, to go through and talk about how to plan your finances in your final years, in your retirement years. And it's not so much about how much to save and what to do with it. It's more about getting organized. It's more about getting your wishes put in place and how to have that conversation, that if at some point you can't advocate on your behalf for your own financial situation. It's little things such as adding, your son or daughter's name to your bank accounts, things like that, and having an advocate. So it's a step-by-step process. It's a really in-depth program. It's really nice to have. You can print it off, or you can do it electronically online and save it as well. I'll send you a link to this, but it's just a great help from AARP to help keep your financial house in order as well. And then when we talk about, and we do this in a webinar we're coming up here in a few weeks, the major threats to your nest egg. There are 5 major threats to your nest egg: taking care of elderly parents, death of a spouse without life insurance, boomerang children, medical crisis, and overexposure to the stock market as you age. And if you've been watching the stock market lately, you know that it's been going up and down and up and down and up and down. And can you afford to take a hit to your retirement savings if you don't have time to make it up? We saw back in 2008, 2009, about a 50% drop in the stock market. It's climbed up since. It's down significantly this year, that type of stuff like that. But having a plan in place as you age is important, because right now, savings rates are low. I mean, you can't go to the bank and get a CD rate, a money market, or even a savings account that pays you more than a few cents a month, depending on what you have. Inflation's going up, stock market's going down. It's making all these things not fun for your retirement savings in your nest egg. OREA has a plan that they've endorsed. It's an asset protection plan that allows you to participate in the upside of the market without any downside risk. And it also gives you some long-term care benefits that are out there as well. So pretty neat plan that's out there. We can help you understand what that is as well. Well, let's talk about RMDs. This is something that Janet had asked me to cover, about required minimum distributions. And this is, it's not officially, but this is how I perceive it. It's how the government gets their share. You've saved up money in these tax qualified accounts, such as your IRAs, a 401k or a 403b, which is specifically designed for teachers. Maybe you had a 403b that you were putting in $25 a paycheck all throughout your career. Now it's grown to a nice little nest egg. Your spouse has a 401k, 457 account, maybe if you were a superintendent or a school business official, something like that, or administration. Those are tax deferred accounts, meaning that you didn't pay taxes on the money when it was taken out of your paycheck and it was put into an account. So you've never paid taxes on it. So we're not talking about money such as your Roth IRAs. We're not talking about pension money, even though that was usually pre-tax. It's a totally different situation. And we're not talking about CDs and money markets of money you've saved up after the fact and put into the bank. We're talking about pre-tax money out here. And what you've got with a required minimum distribution is the government says that you have to take a portion of those pre-tax dollars based on your age, and you've got to take them out and spend them or do something with them. You've got to incur that tax amount. So the government puts together a tax table every year, and that amount grows that you have to take out every year as you age. It's based on the account balance from the previous year. I'm going to show you an example of how that works. The government recently made a change in this. Prior to 2020, you had to start taking out some of your money out of your tax deferred accounts at age 70 and a half. COVID came in, stock market dropped. They said, hey, we can't afford for people to take monies out right now because they're going to take losses on some of this stuff. We want to change that age. It's been moved up to age 72. So you have to take your first required minimum distribution by April 1st of the year after you turn 72. So if you turn 72 this year in 2022, then by April 1st of next year, you have to take a portion of your tax deferred monies out before April 1st. And then you have to take it out by December 31st in each subsequent year. So if you'd wait until the year following you turn 72, you're gonna have to take a distribution out by April 1st and by December 31st, okay? So these distributions, these required minimum amounts of money, they are calculated based on an IRS table. And it's an aggregate of all of your IRA accounts, okay? So if you've got an IRA account 1 and IRA account 2, you aggregate them all and apply this table. Now, most tax providers, tax preparers, they'll do all this for you. It's based on the previous year's close and the account year was. Any 401k, any 403b or 457b, those are each considered separately. They're done separate of any type of IRA that you've got set up. So to give you an example here, this is Nancy, age 72. Her IRA, number 1, end of last year was $125,000. Her IRA, number 2, her individual retirement account, tax qualified, tax deferred money was $100,000. So she got $225,000. She takes the IRS factor and divides that factor for her age by 27.4. That means she has to take out a taxable amount of $8,211 and change out of those IRAs collectively. And I'll talk about that in a moment. This is not what you owe the IRS. You don't owe the IRS that money. This $8,200 is added to your gross income, your pension, your Social Security, any other wages that you have. It's all added to that. And then that determines how much tax that you owe. So then you just follow your normal tax processes that way. It can impact what you owe in taxes because it can move you up to a different bracket. It can impact your deductions, meaning that you may not qualify for a standard deduction. You may have to go itemized or vice versa, that type of thing. And it can impact your Medicare premiums. If you remember back at the beginning of the conversation, Medicare premiums, once you reach a certain household income, your Medicare premiums go up. They're indexed based on your income. So you could have a below the Medicare step-up cost and then get your RMDs come in, and then that kicks you up and you have to pay more for Medicare. So there's a lot of things to think about in this RMD world, but you want to pay attention real quickly, some things to watch out for. If you forget to take your RMDs, if you forget to take your required minimum distribution, there is a 50% tax penalty on top of the taxes that you have anyway. So most plans, and I'm going to say this, and I'm not a personal advisor. This is all responsible on you from your tax preparer or from the plan advisor that you have there. Most 401k, 403b, and 457 plans, they have it automatically set to send you your RMDs. Many individual IRA holders, whether you're your personal Fidelity guy, your Charles Schwab guy, that kind of stuff like that, they are responsible for doing this, but sometimes they forget. It's not their fault. I say their fault. They're not penalized for forgetting. You're the one that's penalized if they forget. So pay attention. You need to be responsible for taking out your RMDs You need to pay attention to the paperwork that the company sends you that tell you, based on your age, based on this account, you're responsible for this amount of RMD. Now, they don't know what your other accounts look like. You're responsible for that. You can determine where you take your IRA required minimum distributions from. Now, your 401ks, your 403bs, those type of things, you don't determine where it takes that from. The plan will take that. But if you've got 2 or 3 IRAs sitting around, you can decide, here's my total money I have to take out, but you can pull it all from one IRA. It doesn't have to be from equally from each one of the 3 that you have. So you can decide, well, which fund's doing best? I want to stay away from that type of thing. You can automate your RMDs. You can take them out annually. You can take them out monthly. You can have the company take the taxes out if you want them to or not. You can decide to do it at the end, depending upon your income, depending upon your, I would say, your ability or your inability to set aside certain monies. You may decide, I want to take my taxes out as it's distributed, because it'll all get caught up at the end and you're not responsible for it at the end. So again, you can decide that out there as well. As I mentioned, don't always rely on your fund manager to do your RMDs. I see it all the time. They don't get it and you get stuck with a 50% penalty out there. You don't have to take out cash. Certain IRAs that maybe hold stocks in them or hold certain tangible assets like gold or silver, those type of things, you can take that out. You don't have to take out actual cash out of there. And if you have a much younger spouse, meaning if you've got a spouse that's 10 years younger or more than you, there are special tax treatments for that. And RMDs aren't as big. Don't want to wade into that now. Just know that you may need to plan differently. Talk to your tax advisor on that, so that there are some things that are different in that area. That's some ways that you can think about what you to watch out for with your RMDs. Now, people ask all the time, what if I don't need my RMD? Now, I hope I'm in this position when I retire, that I've got a lot of savings out there, but everything's going along and I don't need that extra income in there. Some people will take their RMDs and they will use that for long-term care, meaning they will set that aside and they'll say, if I need long-term care, boom, I'll use that. They'll take those RMDs and then maybe put it into some type of a long-term care product to pay for their need if they have it in the future. Just know the older that you get, the harder it is to qualify for long-term care, but that's a way that some people use that. They may purchase a life insurance policy that has some type of long-term care feature inside of it, something like that. They may look at a life insurance policy to fund an inheritance out there. Some people will convert it to a Roth IRA, which is an after-tax plan, meaning that you'll pay the taxes up front, put that money into a Roth IRA, and it grows totally tax-free after that, any type of growth that you have in there. They'll reimburse it, invest it in a non-qualified tax plan like a CD, a money market account, an annuity, something like that. Some people will give it to a 529 plan for their grandkids, just fund college expenses that way. It's an easy way. You've got certain gifting rules that you can do, that you can throw your RMDs that way, and then you don't have to worry about any type of penalties on it. Or you can make a qualified charitable contribution. And there are ways that you can do this. Again, talk to your tax preparer, talk to your financial advisor, that allow you up to a certain amount of your RMDs can be transferred to a charity, a 501c3, without any tax consequences or tax complications. Or it may just simply increase your deduction off of your taxes when you do your taxes at the end of the year. So we've talked about a lot of things about RMDs. I know that we could go spend hours on them. I hope it answers some of your questions, Janet. I hope it answered for those of you who are on here talking about RMDs, wanting to know about that. It is a situation that you need to be aware of. The biggest thing is that you can avoid that penalty. Make sure that you take advantage of that, or avoid having to get hit with that as well. So, because we've got many more years to prepare for living. The impact of inflation, changes in our life in terms of spouse or health or things like that, can really impact us. But for the most part, those of us on this call, once you reach age 65, for every year that you live, statistics show you're going to live an additional 2 years. I mean, it's kind of a weird way to look at it, but people are living well into their 90s these days, and having a plan and knowing your financial house can really make your money stretch we can't call the pension board and say, hey, increase my pension, the inflation went up. Now, Sabre and the team and all of you are working towards more cost of living increases, which is great, but those things happen that don't catch up with your pension. So you need to be prepared for more years of living out there. Any questions that are out there, feel free to drop those in the chat. If you want a checklist for your ICOD folder, your in case of death or disaster folder, or you want that link to that AARP document about financial security and the roadmap to financial planning, drop that me an email at john.green@amba.info, and I'd be glad to send you that. You can use the QR code to scan that with your smartphone. Once you hover over that, you can hit up any type of product in there, and we can come back to you. David and the team can answer those questions for you, help you walk through what a plan looks like and what your OREA endorsed benefits are out there for you as well. So any questions, drop them into chat. Hold up your hand on the reaction bar. We can move forward and go about that. I'll come back with the QR code in a moment, or in my email as well. Just a couple of reminders. We're going on a monthly basis for the next couple of months, not every 2 weeks. We're going to talk about protecting your nest egg on the 10th. And we're going to go in those top 5 reasons that I showed you earlier, the top 5 threats to your nest egg and the steps that you can take to protect yourself against those threats. Then in early summer, we're going to talk about all the new discounts. Many of you are getting back out on the road. You're going to see family. You're going places. You're doing things. You're looking for ways to save money. We're going to have a fun webinar, talk about all the new discounts, how to sign up for those programs, take advantage of those things for you as well. So let your friends and coworkers know about this. As we continue to grow at OREA and get younger, there are many of your fellow coworkers that are now coming out of retirement or coming into retirement out of the schoolhouse after the school year ends. Let them know about OREA. Let them know about your local units, your chapters, how to get involved. This is a great way to introduce them to OREA through these webinar series, provide education, let them know what retirement is going to be like as well. So we're going to wrap this up here. Again, I'm going to leave this up here on the screen. If you've got any questions, feel free to drop it into chat.